To the broader economic impact of all of this as we watch those first vaccine doses rolling out. Paul Gruenwald is joining us now. He's S&P Global Ratings chief economist. Paul, we seem to have had this sort of stalling out in momentum as we've seen cases, hospitalizations, deaths climb in the U.S. as a result of coronavirus. How should we think about now this transition period from a healthcare perspective and then by extension an economic perspective as we get to wider deployment of the vaccines?
Okay, first, hi, Julian. Thanks for having me on the show. You're right. We call this limping into 2021 because this current wave was not in our forecast. We don't think it damages the medium to longer term scenario and growth trajectory, but we did push out our economic recovery by a quarter or so. And you're right to say that it's intimately tied in with the adoption of a vaccine. That's not just approval, but it's production, distribution, people actually taking it. But we still think we get the U.S. back to pre-COVID levels middle of next year, Europe a bit later than that. But I think that the narrative where we start to get some normalization around the middle of next year, some of these sectors that you just discussed in the previous segment that were hardest hit, they start to come back. So we're still in that broad narrative that we've been talking about for the last couple of quarters.
Well, I was checking out your 2021 U.S. GDP forecast. You're looking for about, I believe, 4.2%, a 4.2% increase. That's below some of the other targets I've seen out there on the street. What are some of your biggest concerns in the front half of the year?
Well, the front half of the year is going to be first and foremost getting the current wave of the virus under control. And then once we get the virus rolled out again around the middle of the year, we think that would be largely complete. Then we need to start repairing some of the scarring we've seen over the last, in 2020 because of COVID. We know that some sectors, food and beverage, airlines, entertainment, will come back when we get confidence in the vaccine and people start to become mobile again. But then we've got other structural changes in the economy. So sectors like tech, healthcare, online on the upside, and maybe commercial real estate and big box stores on the downside. So all of those structural changes need to happen. And then we've got policy on the back of that. Fiscal policy, we've been saying, needs to cushion the blow and build a bridge to the recovery. So all those pieces have to come together, but that's essentially what we're thinking about in our baseline.
How severe, you mentioned economic scarring, Paul, how severe do you think that scarring will be? Because I look at your 2022 U.S. GDP forecast, 3%, 2023, 2.1%. I see that as, wow, even if we do get most of the U.S. vaccinated, this issue is not going anywhere anytime soon as a growth overhang.
Right. Yeah. Well, maybe we should, say we look at the growth rates, of course, but in this particular crisis, we're actually paying attention to the levels. So one question we keep asking, whether it's the U.S. or Europe or China or anywhere else, is where are we relative to when all of this mess started? So we saw these spectacular growth declines in Q2, some enormous upside. Positive numbers in Q3, and then we're kind of gently going back to where we should be. But the question is, when do we get back to N19 levels? And then has there been any permanent scarring? To your question, we don't think the potential growth rate of the U.S. and other major economies has really been damaged. We're just going to be on a lower path than we were going into this. So, think of two parallel paths. The distance between those paths is the damage from COVID. But hopefully when we kind of settle down, get the vaccine, we get all of our sectoral adjustment, we'll be growing at about the same rate. So we don't have any growth rate scarring, if that makes sense, but we're going to be operating at a lower level.
Well, so then, Paul, I guess related to that, it sounds like this recession, we've heard this from a number of folks, but at least just in outlining that levels discussion, it sounds like this recovery is really not that similar from what we saw after the financial crisis. I mean, that was kind of a resetting, perhaps, of what potential growth could be in the U.S. and developed world. We learned a lot about the dangers of financialization, but it sounds like in a couple of years, we'll look back and say, well, the pandemic happened, but now we're sort of just back to where we were supposed to be.
I wouldn't be quite that casual about it, but you're right. After the global financial crisis, potential growth in the U.S. and other major economies declined. So we essentially had lower productivity from, let's say, demographics, need to save, competition concerns, et cetera. We don't see those types of effects after COVID. And again, we'll get back hopefully to the pre-crisis growth rate, but we're in a sense on a lower parallel path forever. So there has been damage. Again, I would underscore that we need to make these structural changes because of the way COVID has hit the economy, and that's what we're going to be watching beyond 2021. 2021 is going to be the recovery and the vaccine story, hopefully, but in the out years, it's really going to be the economy adjusting to the post-COVID normal, and then again, hopefully on a growth path that's pretty similar to what we saw going into this.
Paul, finally, I want to come back to the short term for just a moment and talk about stimulus, which seems closer and further, and who even knows at this point. You talk in your note about stimulus fatigue on the part of lawmakers. What do you mean by that? And is stimulus as urgent as it was, and they're just sort of getting sick of talking about it?
Let me answer your second question first. Yes, the stimulus is still urgent, particularly here in the U.S. Our U.S. team thinks the biggest bang for the buck is going to be spending on unemployment insurance and state and local governments. Remember, the story here is the government needs to boost demand through public spending while the private spending is weak. So if we don't do that, it prolongs the recovery and makes it more shallow. That's what happened after the global financial crisis. We had premature austerity, if that's the right term, and that was pulling back public demand before the private sector has recovered. Governments in general, both the fiscal authorities and the monetary authorities, have been much more proactive, and we think timely in this particular crisis. So we do need the demand support in 2021. And then again, I think we've talked about this before, the challenge is as we get the private sector recovery, as the vaccine gets rolled out, et cetera, the government has to dial back at that point. But given where we are at the end of 2020 with an economy limping into 2021 and a need for more public demand, we think the stimulus should be now rather than later. It's going to be more helpful the sooner the better.
Yeah. All right, Paul, thank you so much. Appreciate it. Paul Gruenwald is S&P Global Ratings Chief Economist. Appreciate it.